Show.
And we've got Marilyn Cotterman from where, Greg?
Homosassa. Home of the Manatees.
Home of the Manatees. All right. And we are officially live on Facebook for the Thursday edition of the Not Your Average Investor Show. This is the show that while we love Tuesdays and we love the conversations we have on Tuesdays, Greg and I are really starting to enjoy the feel here on Thursdays, where it's just kind of a group of friends hanging out, going back and forth, asking some questions. So we want you to treat it exactly like that. For those of you that have been with us before, welcome back. Lee, Jane, Marilyn, Vinay, everybody in here that we love hanging out with on a Thursday. And for anybody that's new, I got a little bit of housekeeping to give you. First of all, I guess I should introduce myself. I'm your host, Pablo Gonzalez, with my co-host, co-founder of Jwb, real estate investor extraordinaire, Gregg Cohen. Say hello, Greg.
Hello, everybody. Good to be here.
Great to be here. And just so that we all have this family hanging out feel, we want to interact with you as much as possible. So best way to do that is to go to the chat function at the bottom of your screen, hit that, and then it's going to open up, and there's a little blue box right above where you type, that says all panelists. That you want to hit that and drop it down to all panelists and attendees. This is harder to say than it looks, folks. Just ask Gregg Cohen. He struggled with it just this Tuesday, and today I saw you do better, buddy. I'm proud of you. And then if you want to add,
perfect.
Yeah, it's all about iteration, man. And then if you want to ask a question on the show, I would implore you to open up the Q&A box that is also on the bottom of your screen. Tap that open and put your questions in there. I try to keep track of everything and keep the conversation going. If it's in that Q&A box, it's the easiest thing for me. If you put it in the chat box, I will probably get to it. Just disclaimer, I'll probably get to it too, but you may see me go cross-eyed and short circuit. And it's not the best look for Pablo over here. So help me help you. And then last but not least, if you are new here and you just kind of want a primer on what rental income property can do for you, what market, how to analyze the markets you should be in, how to evaluate properties, what the best markets are, all the stuff that JWB has figured out in the last 15 years of doing this on thousands of properties, go to jwbwebclass.com and you'll get to spend some quality time with this good looking fellow over here, Gregg Cohen, explaining everything that comes from the top of his dome and straight into yours. Also, if you want to just have a personalized question and answer session with our team, go to chatwithjwb.com. And that is the easiest way to do it. And now I say we just get started. Greg, tell me what you've been up to today, man. I know that I think that you might take this for granted, but I think the fact that you guys do these quarterly manager meetings are what sets you all apart. So why don't you tell us a little bit about what that looks like?
Yeah. So and kind of what you said there, how do we make sure that, we keep investing in our team and our layers of leadership that we have in our team and our culture. And, I think one of the best things to do that is to have a routine of meetings or, check-ins or whatever it needs to be, but it needs to start from that direct manager to that direct teammate or employee. And it needs to go through all levels of the organization. So one of the things I love the most that we've refined over the years is just our routine of meetings. And, it starts with the employee and the manager. So we have one-to-ones, and they're either done every week or every other week on a one-to-one basis. We have our team meeting, which is every week where we bring all 80 of us into the same room. We have our department meetings, but then it goes and extends farther than that, right? Every Wednesday, the 4 owners, myself included, we go to a different, even when we were working in the office, we go out of the office and we meet for an entire day, and we're pretty much not even allowed to be contacted. We don't take any phone calls. Pablo can attest to it. I don't even answer text messages from 8 to 5 or 6 or whenever we end. And so there's that routine. Well, maybe about 5 years ago or so, we brought these quarterly manager meetings to fruition. And it started with just the 4 owners and our managers at that point in time, which was probably about maybe 8 to 9 individuals at that time. Wonderfully successful. A great job for us all to get on the same page, to learn from the other leaders in the business about the successes and challenges. really over the last 2 years, as we've developed our next layer of leadership, which is our supervisors, we brought our supervisors into the quarterly manager meetings, and an incredible return on that time, right? An incredible experience for the supervisors, but for us as owners, for managers alike, to make sure that really the message of the company long-term and over the next quarter is completely in alignment. So, I definitely don't take it for granted. It's something that's been learned and refined over the years, but this quarterly kind of routine that we are in of making sure our goals are in line with our annual plan, which is in line with our core values and our overall mission, is something that we truly enjoy. And, as now the organization is 80 people strong, and even if we weren't dealing with COVID right now, even if we were all in the office, I don't get to see and interact with a lot of our teammates as much as I want to. And so this is a great opportunity just to continue to build those relationships. So good day. We did it Wednesday. Today was our second day, and it'll be wrapped up tomorrow.
Awesome. Yeah, listen, all I can say is my reason for fascination about all this stuff and why I keep harping to it is because as somebody that came from the outside in to try to help you tell the story of JWB, seeing the culture, getting into that Tuesday morning meeting and seeing how everybody is just on the same page and engaged with everything that y'all are doing all at the same time. And then understanding that the 4 owners of the company, the partners of the company disappear off the face of the map every Wednesday and nothing is, everything goes well. And then finding out that quarterly you do this thing where you're all in a bunker together, figuring it all out. To me, it's just very, very apparent that, and I guess I can bring it back to, right, coming from a very close family, right? Like I come from a family that's very close. My nuclear family's close. My cousins and my uncles and aunts and my grandparents were all very, very close. It's all based around rituals and around common goals and being there. And it's not, it's not lost on me that exists inside your corporation. And, I don't know, man. I think it's amazing.
Yeah.
So,
well, there's no, and the family thing is really important, right? There are certain correlations you can draw to what we are creating here at JWB, and there's really no substitute for time spent, whether that's with your personal family or whether that's with the team you're growing. There's no substitute for time spent. So it's another investment that we make, and it's just got huge payoffs.
Yeah. All right. So let's move off of that. I'm just kind of nerdy on it. Now, what we have started doing on Thursdays is we are bringing up a actual real rental income property, have Gregg break it down for you. And we found that it has been a very value add to the programming here so that everybody can start to really understand dollars and cents and visuals and whatever you need to understand this asset class, Gregg. So can you talk me through a little bit of this beautiful looking house we got here?
Yeah, absolutely. And this is when the questions certainly start to roll in. So as I go through this property, I always try to choose at least one part of the analysis as a teaching moment and to get everybody more familiar with what this looks like when you are purchasing a rental property, right? So we'll go through the main numbers here, and then we'll talk a little bit about the one thing that we'll use as a teaching moment today. But feel free to fire your questions in. This is the feedback we've all gotten from you, especially over the last few weeks as we've been doing this. This is what you want, so don't hold back. We're here for you. But what you're seeing here is a new property that has just become available from JWB. As you can tell from the picture, it's a brand new construction rental property. Pablo, do you remember what percentage of our inventory is brand new construction?
It's about 80% these days.
Yeah, man, close enough, man. It's about 75%, right? As of business planning time, when we started this year in 2020, our goal was to purchase basically 72% of our inventory was expected to be new construction. And then how that has played out is about 75% of our available inventory. When clients come to purchase from us, they'll see brand new construction homes there. And that may change slightly over time here and there, but overall, the takeaway is that brand new construction is the majority of inventory for JWB. Pablo, why is that a great thing for clients?
You're really giving it to me here today, Gregg. It's a great thing for clients because if you are relying on the dynamics of the market to have available renovation properties that make the numbers work and are good for your clientele, then you need to be able to control your own supply chain. So when there isn't enough properties to buy, fix, flip, and refinance, or BIRR, right, or however that is another term that I've learned in this little journey, then you need to count on your bank of land and your construction team to be able to crank out properties that can meet the rental demands of the Jacksonville market and the Jacksonville rental property investors. How'd I do?
Gosh, that was so good, brother. So good. If you have another microphone around, don't drop that one, because that one's kind of important. If you have another microphone, you should drop it right now. It comes down to two things. You hit the number one major, like super advanced savvy point right there, which is inventory, right? Where many people are falling short, finding available inventory. New construction is that way for us to control our own supply chain. That's why we do it. We have 75% of our inventory is new construction, not because we think anything less of renovations. It's just the general public, the general, inventory out there is where you have inventory shortages for renovated properties that you can turn into turnkey rental properties. So that's why, as you go to maybe other turnkey markets or turnkey providers, many of you have already had the experience where you might find somebody you want to work with, but they don't have any properties for you. And it's because of this inventory shortage, because all they do is renovate properties. They haven't figured out, or they can't build new construction. So that's why we love new construction. And that's why you see such a large part of it. We love renovations as well. You will see those offered to you if you make it all the way through a client onboarding with Jwb. The returns are going to be very similar. Our returns are between 9 to 11%. Estimated returns based on conventional financing. Recently, those have gone up for the first time in years. For years and years and years. It even feels a little bit weird with me saying 9 to 11%, because for years and years and years, it was 7 to 9% returns for expected returns for Jwb properties. It just shot up to 9 to 11%. Why did it just shoot up to 9 to 11%, Pablo?
Because of the unique opportunity that historically low interest rates provide.
Absolutely. Absolutely. We've been talking about how much of an opportunity is for interest rates to be so low right now. And for Jwb, we're really conservative when we estimate our interest rates, because it has such an impact on the return on investment that is estimated for you. And we want to under promise and over deliver. So we're only going to put an interest rate on your evaluation that we are confident that you can hit. And it's going to be through our approved lenders. We're going to make sure that we can do it. It might even be a little bit lower depending on how you purchase. So we dropped that expected interest rate from 4.5% down to 4%. And that immediately had a 2% return bump on all of our evals, give or take. So that's huge. That, in essence, shows you why these low interest rates are such an incredible opportunity, and something, if you're thinking about investing in turnkey rental properties, there isn't a better time than right now. Not because I love turnkey rental properties any more today than I did 6 months ago, or any more than I will a year ago. I love interest rates, low interest rates being so low, and they've never been lower. So that is certainly the deal right now. All right. Should we go into some of the numbers then?
Let's go into some of the numbers. We have a couple questions popping in that have to do with this right now, right? So let's go into that. Lee Bishop asks, Greg, last week and this week, the showcase home has been $200K, but both are only one-car garage homes. Is this the normal template for this price range, or is the lot size the limitation?
That's a great question. A lot goes into what type of home we put on that lot. What floor plan can you put onto a lot? And so there's a lot that goes into it. It certainly is about lot size. That's the first and most important thing, right? We're also going to look at what other homes in that neighborhood, what are the number of, how many car garages do they have? Is it a requirement for that neighborhood to have a 2-car garage or a 1-car garage? Or there are even some homes that don't have any garages, right? So what's the neighborhood really requiring? What comps do we have for the rents we can get if it's a 2-car garage versus a 1-car garage? And then if you go all the way back to the acquisition, we know how much it cost per floor plan for us to purchase the home. And we look at, when we purchased the home, could we do that, still produce positive cash flow, still make it profitable for our clients and for Jwb with the certain floor plan on it. So we know what those build costs are all the way back in the beginning. So there's a ton that goes into it. That's why we have such an amazing acquisitions team that makes that decision. It's not a one size fits all, but you'll see some with 2-car garages. You'll see some with 1-car garages. Some will have more square feet, but only 1-car garage. And that really has to do with lot size and some of the setbacks and requirements that you have there as well. So yeah, great question, Lee.
Yeah. So sounds like there is no template of what you build over and over, as much as what you're building out is this financial template, right? Like it has to have the return based on the investment, right? The ROI.
At the end of the day, it's got to have that return. The numbers have to work, but there's so many variables that go into it. And I'll throw another one that I didn't even mention. How many of that same floor plan have we built on that same street, right? Because many times we'll take a piece of land that we may be able to subdivide into 8 homes. And I know we've done that a number of times here on Cocoa Avenue specifically. So if there are 4 other JWB homes on the street and they all look the same like that's not great for the neighborhood as well. So we'll make some of those decisions, but really not much of a difference in terms of 2-car garage versus 1-car garage. They both work.
Interesting. So you try to have diversity of housing stock inside the same street. That's a strength more so than having the same house over and over. Can you tell me why?
Absolutely. Well, yeah, because you just want the neighborhood to look and feel great, right? You don't want it to feel like Pleasantville where, you walk down the house, the street, and everything looks the same. And that takes away from the neighborhood quality. So we're kind of looking for the bigger gain, right? If the neighborhood overall is set up and built correctly, there's going to be a bigger gain for everybody overall. So quite honestly, there are decisions that we make on floor plans that we put in that we decide to make less money as JWB. It costs us more to do a different floor plan sometimes, but we do that for the quality of the neighborhood, because again, you don't want 8 of the same houses on the same street if you happen to build it that way. And everybody wins down the road there, right?
Always long-term thinking. I love it. It's so totally opposed to like the usual developer model, like a Lennar or whatever that comes in and builds the same thing over and over again. And I totally agree. It takes away from that fabric of a neighborhood. And to think that you think about it that way is great. Like to me, it coming from the builder side, right? The builder just thinks, how can I reduce immediate costs? Right. But there is something to the idea that you think long-term, you're going to be there for 30 years. So the fabric of the neighborhood is important to you. And I think that's really cool.
And we do that because we have our own money in these same neighborhoods, right? Mm-hmm. I own rental properties right next to this one or right down the street, so when your money is in it, when you're invested for the long haul right next to your clients, you end up making better long-term decisions as well.
Cool. Tess Karamitsios has a question. The new construction, is it on tear down lots, vacant parcels, or is it bought from a developer?
It sometimes is a tear down, but many times it's a vacant lot. Usually not bought from a developer, because developers, when they develop land, they develop hundreds of lots at one time and they sell them that way. These are what we call infill lots. These are lots where basically all of the horizontal, all of the utilities, everything, all the streets and curbs and everything has already been done in these established neighborhoods. These lots just haven't been built on for whatever reason. Sometimes there's a really beat up house on it and the numbers work where we'll knock down that house and build a new construction one, but that's rare. More often than not, these are lots, onesies, twosies in these neighborhoods that we do the dirty work. Nobody else wants to buy them because the big builders don't want to do onesies and twosies. And then typical home renovators or real estate investors don't know how to build homes. So that's the niche that we've created. So it would either be a tear down, but most likely this one was a vacant lot that maybe it had a mobile home on it. Actually, that's probably what happened. That's pretty common here on Cocoa Avenue. Those lots with mobile homes on them, we purchase them. We can then subdivide those a lot, and then we can, of course, build homes just like this one.
Interesting that Cocoa Avenue, right? Can you speak to that? Like to me, it's, and people that have been there for a while, it's obvious that we know because we've done the show that JWB dominates in specific neighborhoods, and you just really know it. But can you speak to about your ability to just know, oh, Cocoa Avenue, yeah, we have X amount of houses there. Can you talk about that?
There's not a neighborhood well, first of all, I should start by saying out of all of Jacksonville is huge landmass wise, right? We are 3/4 of the size of the state of Rhode Island. That's Jacksonville. You can literally drive for 45 minutes, 50 minutes and still be in Jacksonville. It's huge and it's very spread out. But out of this huge region, we only choose 4 neighborhoods in which to invest. And that's because, we all need to have some perspective here. What we're trying to find is a very specific asset. We're trying to find an asset where you can have low prices, high rents, be surrounded by jobs, and it's in a growth market, right? That is not easy to do. When you do that, you can find something that's positively cash flowing and also has the benefit of long-term home price appreciation. And if you take just the general landscape of the United States, there's really not that many markets that works in, especially if you throw in the home price appreciation component, right? There are a handful of markets out there where you have low prices, high rents, and are surrounded by jobs, so you can get positive cash flow. But there's not a market out there that compares with Jacksonville on that component and the home price appreciation component. So overall, it's hard for us to find assets. Then when we just focus on Jacksonville and we know we're in the right market, we can't just choose any neighborhood in Jacksonville. We focus on these 4 neighborhoods because these are the cash flow sweet spots. On one end of the spectrum, if you go to the neighborhoods that have the lowest prices and still have high rents, that's not a place where we want to be because they're not surrounded by jobs and the neighborhoods aren't where we want to manage your properties, right? There's too much turnover there. There might be violent crime there, right? So you could get great numbers, but it's not going to work for you. So we don't go to those neighborhoods. On the other end of the spectrum, we don't go to middle income and above either, because while you might not have violent crime there and you might not have the turnover, what you have are home prices that are too high to support the rents. And so you don't get positive cash flow. So we take huge if we talk about the United States overall, you cut out huge segments of the population if you're looking for cash flow and appreciation. Then you zero in on Jacksonville because you can get that, but you wipe out huge segments of Jacksonville as well because either the neighborhood's not good enough or the prices don't support the rents and you can't get positive cash flow. So all that being said, there's only 4 neighborhoods that meet our criteria. These are the same neighborhoods I've been investing in since 2006, and we just continue to dominate them. When we think about Coco and why I know Coco so well is because out of the 4 neighborhoods we've been investing in, Coco's neighborhood happens to be the place that we have built the most homes and managed the highest number of homes in a small, probably mile radius. All right, I'm going to throw this one at you, Pablo.
Here we
You
go.
probably don't know this one. This would be crazy if you knew this one. Do you know what's special about what happened in Coco's neighborhood that makes it the place where we have the most builds and that we manage the most properties in a mile radius?
Nah, I'm not even going to pretend.
Yeah, man, that was a tough one. All right, so Coco is basically the epicenter of this build to rent phenomenon. So in 2011, we as JWB figured out that you could buy huge tracts of land or infill lots, and you could build new construction homes, and you could do it for basically the same price that you would be into it for if you bought a renovated home and just renovated it. And we stumbled upon this, and it became, now, as we know, 75% of our inventory. We sell about 450 or 500 homes a year. So it is a huge part of what we do now. Well, the epicenter of that in 2011 was a couple of streets down from Coco. So we bought about 45 lots. We built these new construction homes. It was incredibly successful for residents, for clients. The Wall Street Journal wrote about us in 2013 as being a pioneer in this space. And now, as you do your research, you'll find out the big builders, many hedge funds, many of these private equity groups, they're all getting into build to rent now, but it happens to be right next to Coco. And as you can tell, we've been very successful there. So that's why we have hundreds of homes that we built right around there. And that's why I know Coco so well.
Perfect timing on that one. Malachi had put in the chat that you could write the book on new construction built to rent. I was like, yeah, JWB led the charge with build to rent. And then right after I said that, you gave that story. So
we're so in line.
All the way in line. Listen, we got a bunch of great questions. So I think we just go through these questions. We'll pop this back on as needed. And let's go. So
let's do it.
Sean asks, actually, this is a good one to have the property back on. But Sean asks, what are JWB's purchase price range? My daughter would like to invest, but doesn't have that much capital, as this will be her first investment.
Sean, I think you had sent me a message on Messenger, and so I appreciate you reaching out to me. JWB's, and we'll bring it up here. Paul, is there any way we can kind of zoom in a little bit there? I was checking out the show afterwards. Let's go over to the left-hand side since we're talking about pricing right now.
Okay.
There we go. All right. So you can see the purchase price here of $199,000. What you're going to see for a new construction house for JWB, prices are going to be between $160,000 and $200,000. So what that leaves you with is about a $40,000 minimum initial investment. That would include your down payment plus your closing costs at a minimum. And then for renovations, you may find a slightly lower price depending on the renovation. You're typically looking at maybe about $150,000 or so at the minimum for renovations. And then the price points for renovations can go all the way up to $200,000 as well. Sometimes you have large homes that can earn a lot of rent. Overall, $150,000 to $200,000 including renovations, $160,000 to $200,000 for your new construction properties. And I think he was asking about, if I remember, and Sean, you know what, if you would, Sean, ask me that question that you asked on Messenger specifically about your daughter investing. If you'll throw that in there, I want to make sure I get that answered for you. I can't remember what it was exactly, but throw that back in there and we'll get that answered for you as well.
Yeah, and Greg, I just thought this would be a good time for you to just kind of talk about the different ways to invest, whether it's cash on, like cash or traditional financing or non-recourse financing.
Absolutely. So you can see at the lower third there is your estimated conventional financing, total monthly cash flow, and your estimated conventional financing, total return on investment. So when we're talking about 9 to 11% returns, we're always quoting based on conventional financing. That's just the generally accepted way to do it. And the vast majority of our clients take out a conventional loan to buy the property. Because if you listen to the show, taking out smart debt is such a huge tool for wealth accumulation. We talk about that with clients, and it's a big part of their plan. So you can see that 10.82% return. That's what we're talking about. That's a great deal right there, right? Now, what that equates to as far as cash flow per month is about, you see, $287 a month here. I would say a typical deal for JWB is going to get you somewhere around maybe $200 in cash flow to really, this is one of the highest ones at $287. Now, interesting though, when you would hear, hey, I can see $287 here, why would I ever go for a lower cash flow property, right? Some people say, well, is $287 a better cash flow property than whatever $200 a month in cash flow may be? And I may suggest, or I may purchase myself one that has $200 a month of cash flow because that's a factor of your overall returns, right? Your overall returns are how much cash flow do I get based on what was my initial investment. So if you have a lower purchase price, if you have a smaller home and you only get $200 a month of cash flow, that may be a better return on your investment than one that gets $287 of cash flow because the purchase price might have been lower. So just something for other folks to think about there. That make sense?
Yep, that made sense. That made sense. Good to know.
So $287 in cash flow, that is what a normal month would be for this property. So a normal month basically takes into account how much rent do I collect minus my PITI. PITI stands for principal, interest, taxes, and insurance. That's what your typical mortgage payment would include. So you got your rents coming in, take out your PITI, your principal, interest, taxes, and insurance, and then take out your property management fees. And that's what this will net for you on a monthly basis. We don't include maintenance costs or vacancy costs because you don't typically have those in a normal month, right? This is what a normal month picture would be. We also don't include tax savings or principal pay down or home price appreciation because, again, the focus of the cash flow number is trying to put in people's minds, what am I going to receive on a normal month, which the vast majority of months here when you're a client of JWB are normal. When we go to the return on investment calculation, that includes almost all of everything that I just said there, right? That includes your maintenance cost. That includes your vacancy costs, right? These are things that you're going to see as you own rental properties. It also includes your benefits such as tax savings and principal pay down. Your tax savings are how much you're able to benefit from using the depreciation write-off. Depreciation meaning your taxable depreciation, not depreciation of the value of the asset. And then your principal pay down being simply what the tenant or the resident is paying down for you, how much of your loan balance the tenant is paying down for you every single month. So it includes those four things. It does not include home price appreciation. So as we've talked about a little bit more in detail, especially over the last few weeks, and as we talked about with Keith on Tuesday, when you use smart debt, you use smart debt responsibly to invest in an asset that pays for itself every single month and appreciates over time, your returns can get supercharged. And I don't usually like to say really high returns because I think it attracts the wrong type of maybe speculative clients. But the reality is that if you include home price appreciation here, typical home price appreciation in Jacksonville averages about 4.3%. That's since 1991. That's the long-term historical appreciation rate. And you put 25% down when you purchase. The property appreciates 4% and you only put 25% down. That's an additional 16% return on top of this 11% return that you could experience. Now you have to hold on to it for a full market cycle, 10 to 20 years, but that's what you can experience. And that's one of the reasons why so many people love investing in rental properties, especially using smart debt.
All right. So I'm going to stop sharing real quick. We've reached the half an hour mark where we normally have a drop off. So I just want to tell everybody, right? Thank you for coming so far. We're going to continue on. We got a couple of great questions that we're going to continue addressing. I put in the chat that we'd love it if you're not already there for you to join our Facebook group. Go to jwbfacebookgroup.com. That's our little cool club that is not so little anymore. We have 1,500 plus investors and people that are interested in Jacksonville real estate, just like yourselves. Gregg goes live in there every single day, Monday through Friday with his world famous real estate walk and talks where he's just giving out nuggets all day long. And we interact in there throughout the week, right? So it's become our community. Would love to have you on board. And again, if you want the fundamentals of all this stuff, go to jwbwebclass.com, check that out. And if you want to hop on a call with anybody from the sales team, go to chatwithjwb.com, and that will be the most frictionless way to get whatever question you have answered, so you don't have to wait for me to fumble all over all this stuff and ask Gregg the question myself here. That being said, somebody that's been waiting patiently here, Andrew Maholani. I hope that I pronounced that correctly. Andrew, he says, hey guys, will you be talking about the eviction moratorium and extension, as well as how you are handling the tenants that are not paying, or how you would handle them, please?
Yes, great lead-in for some timely news that we should share. So the eviction moratorium has been extended in the state of Florida yet again. So it was extended all the way through August 1st. And then the governor has this weird way of waiting to the very final moment to talk about any possible extensions. And so nobody really knew if it was going to be extended or not. It was extended late last night again through August into September 1st. So what this means is that as a property management company or a landlord, if your tenant does not pay rent, you cannot evict them at this moment. And that does not mean that the rent is forgiven. It just means that you can't evict. So what's happening is that for those residents who either can't or are not paying rent, the bill is racking up as it has been. I think the first moratorium was probably April 1st, if I could be wrong on that. But it's been that way for 4 months now or so. So what are we doing? Well, this is just an unprecedented, really difficult time as a property manager, but it doesn't mean that you can't collect rent at a high rate. We've been sharing our rent collection percentages ever since this broke. Even when I didn't know what to expect as far as rent collection, we shared it with you because I think it's important to be transparent at this time. And the reality is when coronavirus broke, there's not a single property manager in the world that knew what to expect. This has never happened. So what we've been able to do is to show our rent collection percentage being very strong. And we do it, and I'll walk through a number of the techniques that we have, but our normal rent collection comes in at about 98.5% on a normal pre-coronavirus month. March actually ended above that, and March, April, and May and June have all been either 97% or above. So we've been within 1% to about 1.5% every single month during coronavirus time while we have not been able to evict. So how do you do that? Well, number one, it starts with bringing the right residents on board. It starts with your tenant screening criteria being strong so that people can withstand, and the right people are in your homes. And then, as part of your screening criteria, we make sure that we invest for the long haul with these relationships that we have with residents. We only sign residents that are 2 and 3 year leases. So right off the bat, there's more engagement, there's more of a relationship building atmosphere than you would have if it's just a transactional 1-year lease. And that goes a long way with us. Now, as I get a little bit more granular on what have we actually done during coronavirus time, well, the first thing is education with the resident, making sure that they understand that, there are a lot of programs out there that can help them if they are experiencing challenges right now. And so while the stimulus bill, that the first round, the CARES Act, provided $600 a week for those who are on unemployment. So we facilitated that. We explained to our residents that, we know you want to be here long-term with us. If you can afford to pay the rent right now, we should be doing it. And the reason is because this does not forgive the rent. It only creates a hassle later on. And we don't want this eventually, people are going to evict again. The moratorium is going to be lifted, and we don't want to have to be in that position. And so through that thoughtful, careful education process, we were able to get a lot of residents on board. And quite frankly, a lot of people just didn't understand what a moratorium meant. I had never heard of this before. I didn't know what it meant right off the bat. So you can put yourself in the shoes of a resident. So we're able to connect the dots a lot for our residents and really show them how the win-win can be achieved from programs that are there to support them if they are experiencing hardship, and then how at the end of the day, the rent is not forgiven. There is going to be a bill to be paid. And so let's work on a plan to do that. We have done a couple of other things. We have waived late fees, which is a huge expense to JWB, right? That would otherwise be income that would be coming to JWB. We waived late fees very early on. We also were very willing to work on payment plans if it was necessary. If there was a reason that somebody needed to get some support, we're very willing to work with them on that. So there's a lot that's been done. I will leave it with this. I get the question now, like, what about those tenants, those residents who are not paying, and it's been 3 months or 4 months? What do we do at that point? What do we do to solve this issue? And, knowing that eviction is not a possibility right now. I can't even talk about it, right? So we do a lot to establish communication. We think occupancy in the home right now is the best thing for them and for us and for the owners of our properties. And so we focus on communication. Whatever is necessary to establish some communication is a great thing. So there are extra phone calls, extra texts, extra emails, extra letters, even drop-bys the home if that's necessary. We do whatever we can to establish communication. And knowing that occupancy and treating people with compassion is the right thing to do right now, we most of the time can establish some sort of incremental payment plan that at some level somebody can afford, which is a great sign to keep them in the home, continues to have income coming in for our owners, and ultimately can create maybe not the ideal scenario, but the best scenario out of which the hand that we're dealt at the moment.
Great. Really well encompassed. Quick follow-up to that, and we'll move on, is John Tennyson asks, as far as evictions on moratoriums, does that apply to people that are still fully employed?
Yes. The eviction moratorium means that you cannot evict somebody for non-payment no matter what the circumstances are for their non-payment.
Got it. All right. So Lee Bishop asks, I just found out that an owner using non-recourse loan to purchase a rental income property is not subject to the same limitations as owners that use Fannie Mae or Freddie Mac lending to purchase a rental property. Greg, is there anything else you may know off the top of your head on this issue?
Yes, that is another thing that is great to clear up. So when we're talking about an owner of a property who has non-recourse debt on it, that's a very specific type of loan. How does that relate to the ability to evict a tenant if they have non-payment is the question here. Well, the Florida moratorium on eviction supersedes anything that has to do with whatever type of loan you have. If you have a loan on the property, if you don't have a loan on the property, nobody can evict while this Florida moratorium on evictions is in place. So regardless, Lee, what type of non-recourse loan that investor has or conventional loan or whatnot, it doesn't matter as we stand here currently. When the CARES Act was passed, the CARES Act put in a stipulation that nobody could evict or they couldn't foreclose on somebody who had a loan that was federally backed by Fannie Mae or Freddie Mac or a government sponsored entity. So what that brought into question, and for Lee's question, is a non-recourse loan is not one of those government backed loans. It's not one of those. So if we didn't have this Florida moratorium on evictions right now, and Lee, or the investor that Lee's speaking about, had a resident that wasn't paying, could we have evicted that person? In this fictitious example, yes, we could have. However, the Florida moratorium on evictions superseded that. And that the CARES Act and the difference between the type of loans only went through, I believe it, don't quote me on this, I think it went through July 27th anyways. So that stipulation has ended. The Florida moratorium is in through September 1st. So that's all we're paying attention to right now. That's the only guideline. And then something else to note is that a new stimulus plan package is in the works in Congress right now. We don't know what will come of that in terms of stimulus and what will come of that in terms of limitations as well. So we'll certainly keep you updated there.
There you go. John Evans asked, I think this was answered. He said that there was a mobile home on that lot previously, and has JWB bought up these and replaced with new construction? That answer is yes, right? You do often buy a lot that has a mobile home and you put a new construction home in there.
Absolutely. You know what? I'll say one thing about that. I always like to give people the real experience when you're buying a turnkey rental property, right? And, you know, as I was talking about how hard it is to find these assets in the general landscape of the United States, and then even in Jacksonville, you know, you're searching for a very specific type of asset. Well, when you find that type of asset, it needs to be in a below average, below middle income housing market, right? In a neighborhood that's below middle income. Well, in below middle income housing markets, it is very common that you might find mobile homes down the street, right? Or you might find a house down the street that is boarded up. Is that okay to buy a turnkey rental property in that neighborhood? And what I tell people is, what are your priorities with this investment? Because there's no perfect investment out there, right? If your priority is to buy an asset that has positive cash flow, that will appreciate over the long haul if you hold on to it long enough, that is surrounded by jobs, that has a strong rental base, and that has great management in place, if that is a bigger priority for you than seeing a mobile home down the road, then I would tell you that there's no problem with buying a house that has a mobile home next to it or down the street, right? That's how JWB feels about it, right? That's where we put all of our investors. We put them in neighborhoods that are built for cash flow. One of the side effects of being built for cash flow is that neighborhood might not be a place that you want to live in. So if you want to do that, if you want to have an asset that's going to be positively cash flow, you got to get over the fact that you're going to see some mobile homes down the street, or you're going to see a house that's boarded up, or you're going to see, you drive down the neighborhood and there's going to be somebody who parks their car on the lawn, right? That's very, very normal. And the reason that's okay is because you have to give and take in any investment. There's no perfect investment out there. If you want to go to a place where there's no mobile homes, and you want to go to a place where every house is pristine and everybody parks their car in their garage, you're going to be in a place where there's not positive cash flow. And positive cash flow is the number one rule when investing in rental properties.
All right. Tess Karamitzios, this is kind of a question we've never, I mean, it's definitely something we've never asked before, but
you sound a little scared. You sound a little scared.
No. I just don't know how you're going to answer this, right? But Tess Karamitzios asks, have you considered building as a premier / eco-friendly / green builder? Here in Northern Massachusetts, developer David Hall created this and has a few units, rental, solar, bio, etc., on a parcel considered wasteland. Is that something that you've ever considered, the sustainability of the construction of the homes as a market differentiator? No, we haven't. I would say that we probably have considered it, but it's not something that we're focused on at the moment, because we feel like we've carved out a niche right now that can serve so many people so well. That to do some of these things, to spend the money necessary to do some of those things, would create a situation where we couldn't provide great housing for these residents. We couldn't create great investments for our clients. And so it would really price us out of a lot of what we do right now. So it wouldn't be an initiative to fully go to these eco-friendly, or maybe like create a niche out of it. We make incremental gains on our assets to make sure that we can be more and more eco-friendly and do some of those
incremental gains. But at the end of the day right now, it's really hard to find the assets that we have overall. And we've got to stay in that box because it creates so much good for communities, residents, clients, team, yada, yada, yada. And we can still make those incremental gains on that.
Yeah, Tess, and I can tell you as somebody that used to own a green building consulting company, that the things that are green in homes are things that JWB seems like they already do, right? Like the idea of making sure that maintenance is reduced is a green aspect. Lack of waste, urban infill is considered green, right? Like it sounds like you were talking about some of the more physically visible green things like solar panels and stuff like that. And I know that at that point will create a situation where cash flow just isn't the same way, just coming from having built a bunch of green things. It's a different outlook and it's a different way to consider things. But anyways, just figured I'd throw in my perspective as a former green building expert. But Tess has another question that's right up your alley. And it is, have the recourse loans lowered in rates? I'm assuming she means the non-recourse loans. Have they lowered?
Yeah, let's first describe what a non-recourse loan is first. Sometimes we throw terms around that are really new for a lot of folks. So when Tess is talking about a non-recourse loan, that's a loan that doesn't fit into what we'll call the conventional box. Right? A non-recourse loan means that it's a lender out there who makes a loan to you, Tess, who, if you don't make the payments, they don't go after your credit score. And for any bank out there, that is the number one thing that they want to do if you don't make your payments, because that's the thing that's going to give you the most, that's going to increase their chances of receiving your payment as much. Now, they also take the houses back. But if you take away the ability for a lender, a bank, to have recourse against your credit score, that scares them. So there's a whole lot less of those lenders out there. Now, why would you need to work with a lender that doesn't go after your credit score? Well, it's not something you would typically do for buying a property in your personal name. It's something that you would do if you're buying a property in your retirement account, in your 401k or your IRA. Because your 401k or your IRA or your retirement accounts do not have a credit score to go after. So it's the only option to get lending for a retirement vehicle like an IRA or a 401k. So that's non-recourse lending. Recourse lending would be your typical bank loans that can come after your credit score. So we think of, when we talk about conventional financing, another term for conventional financing would be recourse lending. That happens to be conventional financing. Conventional really means that it's supported by Fannie Mae and Freddie Mac, because you get the best, most advantageous terms on your loans. So when we're talking about 4% interest rates, we're talking about conventional financing, which is also recourse financing, meaning you buy it in your personal name. If you don't make the payments, the bank's going to take your house and it's going to ruin your credit for the next 7 years. So have rates gone down for non-recourse financing? Well, it depends on your perspective. When I started to invest, almost 15 years ago. Well, first of all, I didn't know about non-recourse 15 years ago, but let's say 10 years ago, 12 years ago, interest rates for non-recourse financing were way higher than they are right now. A lot of our clients bought properties with non-recourse loans. I have non-recourse loans in place at 12% interest rates. And the length of the term to pay it back was 10 years at that point in time, which is really short. Normally you have longer than that. For a conventional loan, you have 30 years, which if you have a 30-year loan, that means a smaller payment every single month. So a 10-year loan means you have a much larger payment. So 12% interest and 10 years to pay back was what the market bared back in the day. It has since come down. It's come down over the years, and especially based on our relationship with our non-recourse lenders. Right now, it's 7.5%, which is phenomenal for non-recourse loans. The term on it also is longer. It's 20 years now. And the way that we've been able to work that with our non-recourse lenders is because our number one goal is that the asset has to pay for itself and create positive cash flow. So we were able to work on this relationship with our non-recourse lenders and said, guys, we're going to need this to be, if it's 7.5% in 20 years, then we can make these assets work. If it was 7.5% and 10-year loans, these would be cash flow negative and it wouldn't work for our investors. We're not going to put investors in that spot. So yes, non-recourse loan terms have gotten better over the years. it's been 7.5% in 20 years, maybe for about, I don't know, maybe 6 months or so, 9 months is my guess.
There you go. So yes, depending on your window of time that you're looking at it.
There you go.
There's another non-recourse loan question here from Matthew Pernat. I hope I'm pronouncing that correctly as well. From a previous show, non-recourse loans through Jwb Lenders had a 50% LTV cap. I have found other lenders offering up to 65% LTV for non-recourse loans. Must we use a Jwb lender?
Great question. The answer is yes. You must use a Jwb approved lender for either non-recourse or recourse. So the question is why? Why if and we're aware that there are other non-recourse lenders out there who would only require 35% down. And there are other non-recourse lenders out there who will tell you that you can get a lower interest rate than 7.5%. And so why would Jwb make it so that you have to purchase through our non-recourse lenders who are approved in our network? Well, the first thought that most people have is because Jwb makes a referral fee off of this. We do not. We do not make any money off of referral fees to our lenders. We don't make any money off of referral fees to our insurance partners. Our total focus on this is to make sure that you get the best return on your investment. The reality is that those other non-recourse lenders who you're talking about, we've worked with in the past. We had a terrible experience in the past. Non-recourse is such a small segment of the lending population. There's not a lot of players out there. So these players have a lot of power, we'll call it, right? And if you're a one-off individual, if they don't really get the bigger picture of like a deal flow, like Jwb sends hundreds of non-recourse loans to our lenders, right? And they work with us. It's a partnership on terms and all that good stuff. These other non-recourse lenders, for whatever reason, might not understand that, or they may not be willing to do that. And if you're a one-off investor, what's going to happen is they're not going to do what they say they're going to do all the time. So we have an example, might be with that same lender who you're speaking with. And we had a client who was purchasing 2 homes. They were both non-recourse loans, and they were both new construction homes, and they were on the same street that Jwb built at the exact same time. And so we tried it out with this non-recourse lender. And would you believe that, first of all, the customer service was terrible, which we care tremendously about. So the client experience, it was bad, and it reflected poorly on us. But at the end of the day, they put this client through the ringer. It was months of documentation and all this good stuff. And then at the end of the day, the last hour, they approved one of the loans and they denied the other loan. It was the same property on the same, it was the same type of property, same floor plan, same build, same builder, the same time. And they approved one and they didn't approve another. And they couldn't tell us why. It went to the fictitious underwriter who made this call. And so, and we have a number of other examples of similar frustrations. So the reality is that, they just don't do what they say they're going to do. We've come to that conclusion. We've worked with many of the people that I'm sure you're speaking with out there, and it's a poor service experience for clients. It's a poor service experience for us. We can't count on it. And so we believe that the best return on your investment and the best experience of somebody who's actually going to close are the lenders that we have in our network.
Makes perfect sense. I was really happy that when you started saying why, you weren't just going to put it on me because I had no idea how to answer. So, Gregg, I know that you are in the middle of your quarterly manager meetings. We have like 7 more questions left here. Do we want to just kind of go one by one and you either answer it as quickly as you can or say better to go to chatwithjwb.com or something like that?
I would love to stay, but I do have another meeting. So I'm not going to be able to handle all 7 here, but why don't we do this? Why don't we take maybe 1 or 2 more? And then if I could ask those folks who maybe don't have their question answered, post it in the group. Go to the group, post it in the group, and I will make sure I answer that question for you today. I'm in the group routinely. I may even use that question as the walk and talk that I'm going to do here later. So the way to go to the group is jwbfacebookgroup.com. Like Butta, Pablo's right there. You just put it in the chat there, jwbfacebookgroup.com. Go there. We'll approve you to get in the group, and then you can just post it right there, and I'll make sure I get that answer for you today.
All right, now you put a lot of a lot of pressure on me having to pick one out. I'm just gonna go with it, right? Mike Foster asks if you do property management outside of Jacksonville. You don't do property management outside of Jacksonville, right?
Correct. It's only, well, all right. So it's Northeast Florida. There's Jacksonville, there's St. John's, there's Green Cove Springs. If we're being very specific, we stay within a 45-minute radius of our office. So Northeast Florida is where we're at.
Right. Mark Norman asks, do you work with an insurance company that your clients can use, or are they on their own for getting insurance?
Oh, Mark, we got you covered, brother. It's all about being passive. Every part of this should be a wonderful experience for you. That's the reason you're going to come to JWB versus trying to buy rental properties yourself. So through the onboarding process with our team, we would make that introduction to you. We recommend the Ritchie Insurance Group. Whitney Ritchie, who runs the Whitney. Oh my goodness, man.
The Ritchie Insurance
Whitney runs
Group.
the Whitney Ritchie Insurance Group, is an avid contributor in our group. She might even be watching now. And she has all of my personal insurance. I recommend her. And so we make that introduction to you as a part of the closing process. And even one better than that, all of your homes would already have been quoted by the time we made a recommendation for you. So you're going to know exactly what your insurance premiums are going to cost each year. It's already on your evaluation. So we got you covered, and we'll make that recommendation for you.
There you go. And also, not just that, she's also one of the best episodes of the Not Your Average Investor show that you can find on the YouTube channel, or you can find in the podcast. If you just Google or type into YouTube or any podcast platform, Not Your Average Investor show. Really, really entertaining conversation we had with her. And I think that's it, Greg. I think we got to get you to your next meeting. I will, like we said, please join the Facebook group, put them in there. I'm taking note of these things also. I'm going to send them to Kate, see if we get any of these answered. I see Rob Jones is asking for some questions. I think your portfolio manager would be a great person to ask that, Greg, about Rob on your property on Brandywine. Make sure that you use your portfolio managers that every client here gets. Mm-hmm. And apart from that, I just want to thank everybody. Next week on Tuesday, we have, I'm blanking out on his name. He's the owner of the Jumbo Shrimp.
Ken Babby.
I was going to say Ken Darby, and I didn't want to mess it up. Owner of the Jumbo Shrimp. It's a minor league baseball club in town here, in downtown, in the middle of some really, really exciting real estate stuff. And really the reason we're bringing him on is because sports and sports teams are really a real estate play. So we're going to break down that business model. And he also happens to own a minor league team in Cleveland and Akron, actually, which is Greg's biggest rival. So, not
As
just
a Pittsburgh Steelers fan,
yeah.
We're going to talk a lot of trash about anything surrounding Cleveland.
Talk a lot of trash. And it's also a rental income property market that people often compare to Jacksonville. So I think it's going to be really, really interesting to be a part of it. So we hope that you're a part of it on Tuesday. Thank you for spending time with us on Thursday. We love this stuff. All these questions are amazing. Greg, I leave it up to you to finish.
Yeah, I'm super excited. Thank you all for being here today. And I'm super excited for Ken being on here on Tuesday. Like, how often do you get to speak to an owner of a professional sports team, right? Who happens to be in downtown Jacksonville, who sees what's going on in downtown Jacksonville as JWB and other developers make some big strides and purchase buildings, and what does that mean for him, and where does he see this going? I mean, it's going to be an incredible opportunity. So looking forward. Hopefully you guys will make the time in your calendar, 12:30 Eastern on Tuesday. We're looking forward to it, and thank you guys.
All right, Greg, why don't you get going? I'm gonna just acknowledge some of the people here that have been thanking us. Thank you, Bill Shields. Thank you for being here. Also, Jane. Thank you. Also, Lee. Thank you for the compliments, saying that we're brilliant as always. That's mostly Greg. I'm just here to be funny. Tess, thank you. You have a wonderful afternoon as well. Roger Evans, thank you as well for seeing you again. Leo, good to have you back. Thank you for the compliment. And Louis Visco, also, thank you very much. I hope everybody has a really, really wonderful day, and we hope to see you on Tuesday. And, just so we know, right? So I have a question here from Roger Evans, from Lee Pham, Rob Jones, Lee Pham, and John Tennyson that I'm going to be forwarding on to the team. So I hope everybody has a wonderful rest of your week, and see you in the Facebook group as I am copy and pasting here and trying not to fumble over my words so that I make sure that everything gets answered. Got it. Have a great day. Bye-bye.